Imagine being a young adult in your early 20s. You have your first job, your first apartment, maybe your first credit card. Nobody is really thinking about mortgages, business loans, investment properties, or building serious wealth yet. Credit feels like something for later, so maybe a payment gets missed. Then another one. A credit card gets maxed out, an account goes to collections. You tell yourself you will fix it when you start making more money. But that is where the problem begins. Because bad credit does not stay in your 20s. It can follow you into every major financial decision that comes afterward. A few years later, you might need a car. You have the income to afford the payment, but your credit history makes the lender nervous. You may still get approved, but the interest rate can be much higher. Now you are paying more money every month for the exact same car someone with stronger credit may have financed for less. And that extra money is not building your future. It is paying for your past. Then you need an apartment. Your credit can become part of the screening process. You may face a larger security deposit, additional requirements, or fewer choices depending on the landlord and situation. You start realizing that credit is not only something lenders look at, it can affect how easily you move through everyday life. Then your 30s arrive, your income is higher. Your responsibilities are bigger. Maybe you are thinking about buying a house. This is where the difference between having good credit and ignoring your credit can become much more noticeable. A stronger credit profile can give you access to more financing options and potentially better borrowing terms. A damaged profile can limit your options or make borrowing more expensive. And now the problem is bigger because you are no longer trying to finance a television or a small purchase. You are talking about tens or hundreds of thousands of dollars. Then maybe you decide you want to start a business. You discover that having a business idea is not the same thing as having access to capital. Banks and lenders still care about risk. Your personal credit history can matter, especially when a business is young and does not have a long financial history of its own. So, the credit mistakes you made when you were 22 can suddenly become relevant when you are 35 and trying to build something much bigger. Then comes another realization. Credit is not just about borrowing money. It can be about having options. When your credit is strong, you may have more choices when you need financing. You can potentially shop around instead of accepting the first offer. You can potentially qualify for better credit cards and financial products. You can have more flexibility when an unexpected expense happens. You can use financing strategically instead of desperately. But when your credit is damaged, you may find yourself making financial decisions from a position of weakness. You need the car, so you accept the expensive loan. You need the apartment, so you pay the larger deposit. You need the money, so you accept the higher interest rate. You need the credit card, so you take whatever approval you can get. That is how bad credit can create a cycle. You have less access to affordable financial tools, so you pay more. Because you pay more, it becomes harder to save. Because it is harder to save, emergencies can put you further behind. And when you need financing again, your options may still be limited. Now imagine reaching your 40s or 50s and finally realizing how much time has passed. You may have spent decades paying extra interest, missing opportunities, and rebuilding something that could have been established much earlier. That does not mean someone with bad credit is doomed. Credit can be rebuilt. But rebuilding takes time because lenders are not only looking at what you are doing today, they can also look at your history. That is why taking credit seriously while you are young can be so valuable. You are not building credit just for the credit card in your wallet. You are building a financial reputation that can influence the options available to you years from now. Your 20s can affect your 30s. Your 30s can affect your 40s. And the habits you develop early can either become a foundation or become something you spend years trying to repair. The biggest mistake is thinking credit only matters when you need to borrow money. By the time you desperately need good credit, it may already be too late to build it overnight. The people who understand this early do not necessarily have more money. They simply understand that strong credit can give them more financial options. And in life, having options can be worth more than having money alone. Now take that same story and flip it completely. Imagine being the same young adult in their early 20s, but instead of treating credit like something that can wait, they decide to take it seriously from the beginning. They understand that credit is not free money. It is a financial tool, so they learn how it works. They learn how payments affect their history. They understand that borrowing money comes with responsibility. They avoid taking on debt they cannot manage. And most importantly, they realize they are not building credit for today. They are building it for the person they are going to become. At first, nothing dramatic happens. Their credit improves slowly. There is no overnight transformation. They simply keep making responsible financial decisions over and over again. A few years pass. Now they need a car. Instead of walking into the dealership hoping someone will approve them, they already have an established credit history. They can shop around. They can compare financing offers. They have more negotiating power because they are not completely dependent on whatever deal the dealership puts in front of them. That difference might not seem huge at first, but multiply it across years of borrowing and the savings can become significant. Then they need an apartment. Instead of worrying whether their credit history will become an obstacle, they have a stronger financial profile working in their favor. Then their 30s arrive. This is where taking credit seriously early can really start to separate two completely different financial paths. Remember the person from the first story. They reach their 30s still trying to repair mistakes from their 20s. Meanwhile, this person spent those same years building a stronger financial foundation. Now they are thinking about buying a house. They have more options. They can potentially qualify for better financing terms. They can shop different lenders instead of feeling forced to accept whatever approval they can get. And because they have spent years managing credit responsibly, the idea of borrowing money is no longer automatically scary. They understand how to use it. Then maybe they decide to start a business. This is where the difference becomes even more interesting. A person who has spent years establishing strong personal credit may have an easier time accessing certain financial products than someone who has spent those same years damaging their credit. Their credit history does not guarantee approval. It does not mean every bank will say yes, but it can put them in a much stronger position when opportunities appear. And that is the real advantage. Good credit does not make you rich. It gives you access to financial opportunities that may be harder or more expensive to access with poor credit. Now imagine reaching your 40s. Instead of looking back and thinking about all the financial mistakes you are trying to repair, you can look back and see years of responsible financial history. You have had time to establish relationships with financial institutions. You have had time to understand borrowing. You have had time to learn what lenders look for. You have had time to build a financial profile that can support larger goals. And now something changes psychologically. You stop looking at credit as something you are afraid of. You start looking at it as something you understand. That does not mean maxing out cards. It does not mean borrowing money just because you can. It does not mean collecting debt to look wealthy. It means understanding that responsible access to credit can be a powerful financial tool. And this is where the two stories completely separate. One person spent their 20s saying they would deal with their credit later. The other person spent their 20s preparing their future self. One spent years trying to regain financial opportunities. The other spent those years creating more options. One may have to accept expensive financing because they need the money. The other may be able to shop around because they have choices. One sees credit as something that controls them. The other sees credit as something they can strategically use. And that difference started with something extremely simple. They took it seriously early. That is the part most young adults do not realize. You do not need to be rich to start building strong credit. You do not need a six-figure salary. You do not need to own a business. You do not need to understand every financial strategy in existence. You simply need to understand that the decisions you make today can create opportunities for you years from now. Your 20s can build your 30s. Your 30s can build your 40s. And by the time you reach the stage of life where you want to buy property, start businesses, invest, borrow large amounts of money, or simply have financial flexibility, you may be grateful that you took your credit seriously when nobody else seemed to care. Because good credit is not about impressing people. It is about positioning yourself. Bad credit can make you ask, how can I get approved? Good credit can put you in a position to ask, which option is best for me? That is the difference. And both stories started at the exact same place. The difference was what happened next.